Cool. Hey guys, welcome back to Elite, the High Finance Podcast with Kaushik Ravi, where each time we're joined by incredible guests and thought leaders across the private equity, venture capital, hedge fund, AI, in finance industry to talk in depth about their experiences in the industry and the spaces that they work in. The rationale is there's very few high quality finance podcasts that take you behind the scenes of elite careers and give insights and advice on ways to get better at what professionals do and how to really become the elite and the best. So we've had on amazing speakers already, as you know, from VPs to partner and C-suite level folks across all different types of firms and funds and industries, and obviously even seasoned investors, right? Like Mark Cuban or Anthony Scaramucci, et cetera. This podcast or this forum is for both current professionals at various stages of their career, as well as for aspiring professionals who want to be in the high finance space. So make sure to share it with your friends and colleagues and like and subscribe and all that stuff. Quickly on Onefinnet, we are the premier and largest sort of finance and AI and finance platform, as well as the largest finance network in the world, which is used by the top firms on their business development, capital raising, M&A, AI, talent, all of their needs, as well as top finance professionals across our training development, hiring, coaching, networking, et cetera, platforms. So today we're joined by another incredible private equity speaker, Will Goodman. I've known Will for, very long time, and I'm really excited to have Will on this platform here. He's a vice president at CleanHill Partners, which is one of the fastest growing and leading clean energy asset managers in the world. Obviously, Will I've known for a while, and he's got incredible insights both on the private equity and investing space, careers in that space, as well as on energy. So I'm very excited to welcome Will to this forum, and thanks, Will, for joining us.
Yeah, Kaushik, thank you so much for having me. And I really love, this podcast and all the ways you give back to young finance professionals, undergraduates, MBA students. It's been very helpful for my own career journey. I'm sure it's been very helpful for others. So no Mark Cuban, but hopefully, this can be insightful
Yeah.
for listeners out there.
Amazing. Well, we love obviously hearing that. And I think for anyone that's listening, right, I'd love to have you on in the next few years as you go through your careers and get to sort of kind of more the senior stages so you can help and train the next generation. So thank you, Will, again for being a part of this. And yeah, I'm always excited to see all the great things that you have accomplished and continue to accomplish. So Will, I will split this up into sort of three areas. The first is on sort of the private equity space, your background, kind of the energy investing space overall, the technology within, in energy investing, how you got into it, and all of that. And then I'm going to go to the section two, which is just more detailed into the four main sectors that you guys focus on within sort of the energy investing and technology spaces. And then finally, we're going to talk about sort of career strategy and sort of how do you break into these roles, on the industry side as well as on the private equity side. So without further
Sure.
ado, Will, I would love to kick us off with an introduction. Obviously, your background, how you got into finance, your background in banking and how that sort of prepared you for investing, and what interested you about clean energy and the energy space and the technology space, and go from there. Cool. Let's start with that.
Yeah, absolutely. I think it's a great question. So I really first got introduced to finance at Yale, where I went to undergrad. I studied economics. Didn't have any idea really what finance was prior to college, but I'd say the way I really got introduced was just by talking with more, experienced students like seniors and juniors who had done internships or had worked a little bit in the sector because I was trying to get a flavor and figure out what might be interesting. And finance seemed like at the time a combination of kind of numbers and economics, which I had been interested in, for a while. And so it seemed like kind of the natural place to start, having a very obviously rudimentary understanding of what it actually was. And so did a few finance internships. I thought finance was a fascinating way to really, truly understand the world around us, right? Like understanding how companies work, like everything is a company, right? Like the couch behind you, there's a company that makes that, right? Like there's a company that's making the software that we're interacting through. Like it just seemed like a great way to really understand the world. So that was really the intro to finance. And then I would say, you know, from there, it really deepened in starting a finance club at Yale called Yale Alternative Investments or YI. It's still around today. The club's doing well. It's great to see that. But I think that's where my interest in like the clean energy sector really began, as well as, the finance interest that I've been building continue to develop, where, we got to work with a few energy focused investment funds that are fairly well known in the sector on some projects. And to me, seeing just the scale of change in the sector and all of the new technology that was coming to market, I've always thought disruption was really fascinating. That was super interesting to me. And at the same time, I just thought like, look, every business solves a problem. Like, why don't I look at the businesses that like are solving the most interesting problems? To me, like climate change, energy is a very complicated, interesting problem. So that's really where I got interested in like the sector initially. And so then coming out of college, I did investment banking at Bank of America in their M&A team. It seemed again like the natural place to go to get into the world of finance. I mean, we can talk about that more, but that was my next step. And then from there, I knew it from the experiences in college and also working in banking. I wanted to do something in clean energy. I knew I was interested in investing. And from starting this club and also working at a startup, which I'm happy to talk more about, I knew I wanted to do something entrepreneurial. And that was where, the intersection of those things drew me to CleanHill Partners, which I am to do, which is where I am today, which truly is, a growing, private equity investment fund focused in the sector. So I'll pause there. I know that was a lot, but
No, that's
that's sort of
great.
the arc, if that makes sense.
Yeah, that was great. And I think a couple things for kind of people that are listening, right? So to Will's point, it's not like there was, there's a few different aha moments that you had, but I think it required a lot of introspection, right? Will, it feels like at
Yes.
first you decided that, hey, I want to be in finance, right? You're saying, hey, my mind was gravitating towards figuring out how, a company does this, or how does this, soft sofa business work, or this work or that work. And so you feel like, okay, within the world of business, that's interesting. And within that space, you started taking on projects and you realize, hey, I think clean energy is, combines the things that I'm interested in. One is potentially having be a huge TAM, sort of a huge market to have an impact. Number two, have a huge impact on the world around me. And number three, be able to become an expert in a space that, truly requires sort of specialized expertise and also can have this kind of broader sort of impact. And I think that's what attracted you to it. And in order to get there, you realize, hey, I need to build some sort of skills at the beginning on the banking side and then figure out what the right opportunities. We'll come back to this point, Will, on the sense of like, you know, doing something at a large established firm like a Bank of America, and then at what point does it make sense to maybe do something what you're doing, which is join a growing fund and sort of being part of that, and what is the right time in your career to do that? What should you be looking for in those types of funds? So I
Yeah.
love that journey, Will, and I think. Hopefully that's helpful to a lot of our audience as they're trying to put all these pieces together. It's really as much of the world around you, but also listening internally to the things that interest you and how you define impact and all of that. So thank you. That was a great way to kick us off. One thing I'll say is obviously you mentioned this a little bit earlier. You've been involved with the Elevate and the Onefinnet platform for a while. Maybe talk about a
Mhm.
few different ways where professionals can really or students can like get the most, and how have you found it kind of the most valuable as you've grown up through the finance industry?
Yeah, I think that's a fantastic question. I think the first place I would start was like the networking opportunities through Onefinnet, right? Like that is so valuable, especially as you start to really mature in your career, like especially in private equity, right? Information is so important and it's just a great way to learn too, right? So be able to connect with other investors, other private equity investors who are in my sector about, hey, like what's going on in your portfolio, or like how are you seeing the world? How are you seeing this market? Like, how are you seeing things play out? Like, that is so incredibly valuable. Just A, to learn, B, as an investor, C, maybe down the road, you'll co-invest in something, you'll invest in one of their portfolio companies, et cetera. So I think like, especially as you get further in your career, I think it's a little bit hard to necessarily, see that tangibly in banking, right? But like as you get into investing, especially private equity, incredibly important. And I think the OneFinance platform is fantastic at, at that peer-to-peer networking. So I think that's a fantastic, value proposition for the platform. And then I think just honestly, all of the like career learnings, like having Mark Cuban, on the platform. And obviously, not everything Cuban says or Scaramucci says is going to 100% resonate with the way you think about the world, but there may be like that one nugget that really clicks uh, and really kind of crystallizes the way you think about the world. You're like, huh, like this is how I think about it too. And like he just kind of described it in a way that really helped crystallize it in my mind. Like I think that's obviously been super valuable as well. And then also, when you first came to campus, helping out with training and demystifying the whole process of what is banking, what's out there, how do you break in? I thought that was immensely valuable.
Amazing. Well, thank you, Will, for that. I think I agree on sort of the last point. I think, Will, I know I spoke at Yale several years back, but since 2021 or 20, whenever we started doing this, we've kind of, reached over 100,000 students and professionals. So it's kind of the volume of numbers has been amazing to see. On the second point around learning from others, look, I think you're right. On some of the more senior people, yes, but really all these events, we try to bring on people who are 3 to 5 years ahead of, anyone else, and really learning from people who've been down the pathway, I think is really important. And finally, the networking point, absolutely, whether it's on our platform or otherwise, I think the network really is truly your most important asset. So I agree with Will on that. And it gets harder and harder, honestly, to build a network, which is why we've built our own networking platforms and things like that. But I think as you go through your career, right, we kind of don't have as much time to do it. So cool. Thank you, Will, for kind of kicking us off there. I want to get into a little bit on the energy and the technology side. So, people I think are a little bit scared of the word energy or, the whole space. So maybe help us
Yeah.
understand a little bit of how you think about the various sectors that are in the space. How do you approach it? And even for a layman who may not know about it, like where the most exciting opportunities are, like maybe break down the energy investing sector or industry into various sectors for us.
Yeah, very, very good question, Kaushik. And especially I think in the current, political climate, obviously energy is at the forefront of every conversation around AI and like retail residential electricity prices being a huge political issue, and it's very political. But I guess to broadly get into it, the way I think about it is, energy, there's sort of two categories, right? There's like traditional energy, which is like your more traditional, oil and gas generation, infrastructure supporting that. That's sort of like the traditional energy, right? And then there's like new energy, the energy transition, and that's what people sometimes call clean energy or energy transition or renewables. Like there are a lot of terms, but I just broadly think of this as like a shift to renewable or clean energy sources, and not to like completely abandon, traditional energy, right? Because that's still going to be, I think, a pretty key part of, the energy demand story moving forward, but more so to supplement and add supply because we need more supply, particularly as we'll probably talk about, with AI. Obviously, there's a huge need for power and energy. So I broadly start there. And then I think the way you can think about it from there is like you could either invest in like the infrastructure, right? So like, power plants, pipelines, transmission lines, things like that, right? And you can again bifurcate that into kind of old versus new, or you could invest in the more what I would call picks and shovels, right? So think of this as services, hardware products or hardware businesses to support, you know, new like solar projects or battery storage projects or transmission projects to support that infrastructure, right? Because fundamentally, this is like an infrastructure first story, but there's a lot that needs to go into supporting that software services, hardware products. And then I would say that's sort of on the generation side of the picture. And then I think the other thing that people think of when they think of energy transition is consumption, right? So like transitioning from gas, vehicles to electric vehicles, putting rooftop solar on your home is sort of a hybrid, like in between of, generation and consumption, using like maybe it's, an electric heater in your house, like things like that. That is sort of more the transition on the consumption side to using more just electric, you know, technologies as opposed to traditional oil and gas. So that's sort of how I think about it is there's the generation side, there's everything that supports that, including the infrastructure. There's transmission, obviously, which is mostly infrastructure, but there's obviously a lot of services that go into that. And then there's the consumption and transition to more electric goods, if that makes sense.
Yeah, 100%. I think super awesome, great job to like kick us off on explaining the overview of the landscape. We will
Yeah.
dig into a little bit more of sort of the trends and the business models into those space, but I think that's really helpful for people to get a sense. You touched on this as well. Well, I want to talk about, as an investor, you guys are obviously investing both on the actual the generation consumption side and sort of the products and services as well as the technology behind it. Can you just talk a little bit about the types of technology companies that fit into this that support each of that kind of the picks and shovel sort of analogy that you mentioned? And are these like typical like SaaS types business models? Are you thinking about like, how does a technology investing, kind of fit into the sort of the energy space?
Yeah, no, very great question. So, what I would say is that, with these new energy sources, let's just start on generation, right? Think solar, wind, and battery storage to then supplement solar and wind because the sun doesn't shine all day and the wind doesn't blow all day. So, you may want to kind of store the, power generated and dispatch it later. But I kind of think of that as those as all the new generation resources. Those new generation resources they have basically much more complicated like power outputs, and they just cause much more, I would say, challenges for the grid to deal with. Obviously, A, because they're intermittent, and B, because of sort of the type of power that they generate versus our traditional, gas turbines, which is kind of what the grid was built around, right? So, in order to really adopt these new sources of power generation, you need devices that can, like hardware equipment at each of these projects that can basically, turn the power into like something that's usable for the grid or manage those assets if there's a grid anomaly or grid outage. So you have a lot of kind of sensor technology, uh, power conversion technology, all at like the point of generation that is purely the result of these new forms, right? Solar, wind, storage. Like you need to monitor these assets because they're much more complicated in the type of power they dispatch. Like think about it, right? Like the wind could easily blow super strongly and then subside, right? And that creates like a rapidly volatile power profile. So there's a lot of technology again, software is like managing when the, like the power that might be stored in a battery is dispatched into the grid, managing the quality of the power. There's a lot of technology behind that. So that's kind of one area. And then I think the other exciting area is really on like where technology is really playing a role is like on the consumption side, right? So now like you're starting to see really widespread adoption of rooftop solar and home batteries, right? And the idea is that rooftop solar and home batteries basically will lower your power bill if you're a homeowner, right? But now, like, imagine that you have 10,000 batteries in a neighborhood. You can, in theory, orchestrate those batteries to help the grid out if there's a large stress event, right? And like that's another layer of technology is really like managing all these what we call distributed energy resources, which are it's basically like anything that's, generating or consuming energy, at a fairly medium to large scale at like a home, right? So like managing that, there's a lot of software behind that. There's again a lot of the similar like hardware technology to manage like EV charging, do it in a smart way. So like your charging when power is cheap, again, like managing rooftop solar and battery storage. So that's kind of where a lot of the tech is. And then there are obviously a whole like broad range of other kind of verticals like clean fuels and grid and transmission tech, but I think those are the main ones that we spend a lot of time focusing
That makes
on.
sense. So you first start at like the infrastructure level, which is the actual like the wind and the solar and those types of companies. Then you go to kind of the hardware of the technology that supports
Yep.
that resource itself. Then you're going to the software, which
That
is kind of
manages.
managing behind the scenes and all of that. And then you have more specialized, and maybe at that point you bring in more AI, so sort of companies that can kind of manage all this stuff. So clearly, guys,
Exactly.
already there's a multiple layers here, and it's kind of an interesting blend of the energy climate space and the technology types of companies that we're all familiar with kind of evaluating. So that's super, super interesting. Well,
And
thank
Kaushik, maybe I might add to your point on business model. Like the business models can be really diverse. I would say at like the larger kind of infrastructure scale, whether it's software, whether it's hardware technology, that tends to be like let's just start with the hardware. I guess that tends to be more of like a one-time sale with maybe some ongoing services to support business, right? Maybe you have like a SaaS stream of revenue if you can kind of bundle that with again like a monitoring software, business. On like the more, consumption side of things, that's where you do get into more like service provider type business models where, someone might be providing you a rooftop solar panel or a battery and leasing it to you and, generating more recurring revenues. So I'd say the business model is a little bit more stratified if you're looking at large scale generation versus more consumption.
Amazing. Okay, cool. So it's super, super helpful. Even like this is really neat to me too. We're going to get to the sectors in a second where we're going to go through and kind of talk about each of them. Before we do that, well, I guess talk a little bit about the players in this space, right? So there's obviously there's private equity folks, there's growth folks, there's these kind of large funds, there's sort of emerging funds like you guys that are playing this space. There's
Yeah.
also infra funds out there, maybe like sovereign wealth funds that are investing. So like maybe talk a little bit about kind of all the different types of investors in this space and maybe where some of our professionals can kind of get involved if they're looking at the investing career.
Great question. I think you really want to stratify it by the risk profile that investors are looking at. So let's start with like the lowest end of the risk spectrum, right? There's like traditional infrastructure investors who are investing in solar projects or storage projects that at this point are fairly, relatively commoditized, well understood, have contracts, stable cash flows, like, and that's going to be like your lower risk, like infra tier. Then there's sort of kind of like the emerging infrastructure tier, I would say, for new types of infrastructure that's being, pioneered, scaled. Sort of think of this as like, I'll give an example, maybe like a new type of clean fuel that's being developed. They've proved it at a, pilot scale. Now they want to scale it up to their first commercial plant. So it's sort of, they have some contracts. So it's sort of infrastructure like, but carries a little bit more of, a degree of risk relative to like a very, well understood solar project, right? So like that's like the next tier of risk. And so they're kind of like emerging growth, like infrastructure investors that do some of that as well. And then they also sometimes do some of the more traditional, infra as well. We don't do that. That's not really us, our bread and butter, but there are a lot of funds out there in the sector that do that. Then there's sort of the funds that I would say more traditional to what, or more akin to what we do, which is more traditional private equity, like investing in businesses that have real, like demonstrated commercial traction, real revenues, visibility into cash flow positivity or generating cash flows. Again, these are typically like the hardware, the more established software, the services businesses that are supporting all these industries, and that's more where we play. I would say the range of risk profiles in that slice is actually fairly broad. Like you could get, like a utility infrastructure services, like middle market utility services, like infrastructure company, right? That's been around for 25 years, has EBITDA, has contracts, or you could get, a business that is kind of really in its scale up phase, but has some real traction. So I'd say that's kind of the next slice. We play in that broadband. Uh, it's sort of a mix between private and growth equity. I would say kind of could play either way, but more so of a private equity focus, at least for what we do. Um, and then, there's obviously more traditional kind of growth and venture capital for new technology. So that's how I would
Yeah,
kind of stratify the
that's
landscape.
super helpful. So you have kind of the traditional infra, which is like lower risk projects, kind of these larger scale projects, which maybe kind of like more like a kind of a return coupon, sort of like a lower risk sort of mindset. And then you have where you guys play, or maybe large cap PE also invest in some of those projects, but then a lot of
Yes.
the PE and you guys, which are more the emerging funds, you're investing in more, kind of higher potential technologies, some of software-based companies that support the overall infrastructure of energy. And then you have some more early stage folks who are almost like seeding or growing kind of earlier stage technologies or services in this case, and that kind of grows into come to your foray once they have a set of clients and sort of establish revenue and cash flow. So typical of a VC growth PE model. I guess just one follow up on that. The growth and VC side, I've always seen as being like there's just less like companies in that VC space. Is there a reason for like, is it because there's a lot of CapEx needs and things like that? Like, what do you see in sort of that early stage investing in energy, sort of energy transition, energy technology space?
Yeah. So look, Kaushik, I'll be super candid here. There was, I would say in 2020, right, in the ZERP era, there was, and when Biden had been elected and this, new bill had been passed that extended tax credits for clean projects, there was a lot of what I would call euphoria in the sector and a lot of venture dollars going into companies in this sector. Like I think roughly a quarter of all venture deals during that time period were quote unquote climate tech, right? Which is like early stage companies trying to make products that will go into the sector decarbonize, right? I think the reality is a lot of those investments haven't materialized in the way people thought. Valuations were elevated just given the rate environment and given some of the macro, tailwind and euphoria. Um, and I think a lot of investors candidly got quite burned. And so I think now, that's where you are seeing a little bit more capital, drying up on, the earlier stages of this sector. But I also think to some extent that's a good thing, right? Because you don't want too much capital going into businesses that really don't have a business model that's going to work, right? That's going that the capital is going at such a high valuation and it makes it prohibitive for the next investor to come in, right? Uh, and so you're kind of at this point now where, a lot of these investments were made, maybe they haven't worked out, maybe the investments marked fairly well in the VC's, the growth equity investors portfolio. And so it's hard to commit, new capital into some of those earlier stage companies, just given the business didn't show up, the valuation expectation, didn't materialize, the
Right.
company didn't work out the way people thought. So I think that's been some of the challenge in kind of the earlier stage environment,
Totally
today and
makes
some of the
sense.
capital shortage.
Totally makes sense. I think that makes sense a lot. And it's just because like just like with any market or any sort of like market adjustment, you always kind of gravitate towards quality and cash flows
Exactly.
and things like that. So I think it sort of makes sense to me. Great. Well, thank you so much for I think this has been really helpful on sort of kickoff on energy and investing. I want to just deep dive in a little bit more. There's sort of four main sectors, I suppose you guys spend time on, a lot of the investors spend time on. Power generation, you talked a little bit about it earlier already, the generation side, then there's sort of the grid transmission side, and then there's consumption, and then there's sort of the, you know, digital infrastructure, if you will, like,
Yeah.
that sort of space. So let's maybe go one by one and just two simple questions for each of them. We'll start with each one. The first one is just an overview of the space and what are the best types of business models, like the ones that you see, et cetera. And then we'll just kind of dive into kind of as an investor, what do you look for? So let's start with the space itself. You gave us a little bit of an overview already. Just give us a little bit more of a deep dive on the, kind of the generation space. What are the different types of models out there? Maybe what are some exciting technologies that you're seeing in that space?
Yeah, I think it's a really good question. Um, What I would say is that there's a lot of overlap, first of all, between like these different buckets, to be quite honest. For example, like battery storage helps, add renewable power generation to the grid, also helps relieve some transmission constraints on the grid. So that plays into sort of transmission, right? Also, is now being used on the, residential consumption side. So there's a lot of overlap across all these buckets. But to answer your question, let's start on power generation. I would say that the tip, like what is like the business model of like hardware or services companies? You're really selling into the like these solar projects, right? Or these wind projects or these storage projects. And I think like a really key part of just power generation in general, particularly in context of now AI demand, is like reliability, is like be able to run a project and not have it go down, right? I think that is super critical. So I think the businesses that we really like in the sector, have really, great product quality because often from what we've seen there, while there are sort of price ceilings that these project developers or owners of these projects will pay for, a hardware product or a services product, right? Like they will pay up for a product that just has really great reliability, right? So I'd say having really strong product reliability is key. Having really rapid customer service, like we like businesses that, we look at where like one of their key value propositions is like, hey, we've just got really rapid customer service. We can be on site, super quickly, charge like a decent margin for that service, right? But like that is always going to be key, like a key value proposition. And again, attractive, from a business model standpoint, right? So I'd say like those are two key attributes of business we look at. To give you maybe some more specific like flavors of stuff we're looking at right now, I would say, we invested in a tracker company called FTC Solar. It's a public company, so I won't, disclose anything obviously that's not public here. But so that's a business that basically makes like the structure, the steel structure that the solar panel rests on, and it basically tilts the panel throughout the day to follow the sun across the sky, right? So this is like used in basically every solar project like in the US because it just vastly increases the amount of power that a solar project can generate. And what I think we really like about the business is like that incredible, quality and reliability, like rapid customer service. Like I think another key tenet you'll see in this kind of world is increasingly as hardware costs have come down, like the cost of solar panels has come down so much in the last 10 years because of scale manufacturing out of Asia. So now like more of the cost is in the soft cost, right? Like the cost of installing, the cost of maintenance. Like that is really what is eating at, project margins and returns for these asset owners and the infrastructure investors at the end of the day. So like, their product can drastically reduce, the installation time to set up one of these projects and being able to cut that soft cost, that labor cost, I think is incredibly important. And now what we're starting to see is even a movement towards, and this is earlier stage than what we would play in, but I think it's exciting. So I'm going to talk about it, movement towards robotics, right? So using robotics to install solar projects. A big, a large company in the sector. It's called NextPower, a publicly traded company. They recently made an acquisition, buying a business called Origami Solar, which is focused on developing robotic solutions to install solar. So like this is real, this is tangible, this is happening, like next power, they're a big company, they're investing real dollars into this. So I think that's kind of like the next wave is really reducing the soft cost for this type of infrastructure.
Yeah, amazing. So I think that was super cool because for folks that are interested in energy, I think that's really interesting. But even for the layman, right? Look, Will's talking about the same types of investment merits that you're looking at any sort of business, right? Like strong moat, good kind of customer, traction and sort of customer response time, great technology, innovations, kind of ability to bring down kind of bring up the margins and bring down sort of some of the fixed cost nature of that business. So I think all that makes sense. And then maybe the only follow-up that I have is like when you're underwriting these type of deals, right? There's obviously a lot of reliance on the company specific growth as well as sort of the market specific growth, for instance.
Sure.
So I'm just curious, like how much conviction or how do you drive conviction around like, hey, in the next 5 years, we think overall solar is going to be this, or overall wind is going to be Y, or, battery is going to be Z. And then our company that we're underwriting is going to take on 20% more market share or 30%.
Right.
So really like drive conviction between market growth estimates, because this is different from like selling cars or selling SaaS tech. It's like, okay, we're going to sell the 5% growth, 10% growth every year. In this case, there might be a lot of variability. Just curious how you kind of develop conviction when you're underwriting and these assets or these companies.
Yeah, I think it's a fantastic question. And it's a great question too, because consistently, the consultant forecasts on, solar storage installation annually have been wrong. They've always, underestimated, and every year it comes out higher than what they expected. And I expect this trend to continue. So I would say the way you develop conviction, let's just start, in the macro, and then we can get to the company, right? So like, how do you develop conviction in the macro? I think for us, we're particularly, unit economics focus, right? At the end of the day, power to some extent is a commodity business, right? So it's kind of a question of who can deliver power cheapest, fastest, right? And when you look at just the unit economics, the cost, right? Unsubsidized, like take tax credits out of this, the unsubsidized cost of installing, solar storage when it's lower than gas, and it keeps getting lower, right? So I'd say like that is how you really develop conviction in the macro. And also, you develop conviction by learning about the demand cycle, right? Like what are we seeing in AI, right? Like what would that like power demand look like? What does the range of scenarios look like? And I'd say like practically a really good way to develop conviction too is like leveraging your existing portfolio companies, right? Like what are you seeing in your portfolio in their pipeline? Like are they getting into these, hyperscale data center projects, right? Like is this real demand? Like what's the scale of it? Like that's how you help really validate some of the forecasting work that you're seeing. So I'd say like the way we develop conviction in the macros are like fundamentals, unit economics. How does like how does this company's end customer, solar storage, wind, whatever, compete first entire landscape. B, use your portfolio companies to see what's actually happening in the market. Is the demand really materializing for, this type of power? So that's, I'd say, how you start with the macro. And then like on, the individual company performance, I think that's where you really underwrite a range of outcomes, right? Like you never underwrite to, one particular, case, right? Where you're saying like, hey, we think they can reach, 15, 20% market share. I think that that's more of the art rather than science. It's hard to get a flavor. I think the way you get data points is through diligence. I think like, as an example, like if you're looking at a company, right, and you can kind of get a flavor on their competitors doing calls to customers, like what's going on with the competitors, like are they having challenges? Like does the customer, like want to add another player, right? Like that's another like an easy way to get, conviction that there may be some share capture, and then you kind of have to underwrite to a range, and I think that's kind of how it happens, if that makes sense.
Yeah. No, no, I think
Yeah.
it totally makes sense. I think I definitely see the challenges, obviously. This is why kind of it's important to develop these skills as kind of understanding the industry and all this, but the challenge in kind of digging through the data and figuring out, okay, where is this really headed? But I think the one potential benefit is that you can actually evaluate the technology as is. Like you can actually go and visit these, plants and
Sure.
talk to those customers maybe and actually figure out who's actually using what and so on. It's maybe a little less hypothetical, right, than some like, AI product or something like that. So I think that's super interesting. Well, I think on the
Yeah.
power generation side,
And
um,
Kaushik, sorry, do you mind if I quickly turn on the background light in here? It's just getting a
yeah,
little
yeah,
bit.
yeah, yeah,
Let
go
me
for
just
it. Go for it.
quickly,
Yeah, you're
I'll be
good.
right
Yeah.
back. Okay, apologies. I forget it always gets dark at like,
You're
5 p.m.
good.
now.
Um,
This is
Great.
better.
So I guess the next sector, obviously there's a lot of overlap here, but on the transmission and grid side, which is what you highlighted, maybe tell us a little bit about similar to the generation side, like what are the types of models here then, and kind of like how do you evaluate these types of companies?
Yeah, great question. I think so on the grid side, a lot of like the hardware technology that goes onto the grid, utilities are incredibly conservative. Like they do not like to take risk. So a lot of the hardware that is purchased is going to be like provided by, one of the like big four industrials like ABB, Schneider, Siemens, GE. So I'd say like the grid kind of hardware opportunity is maybe a little bit, less compelling than in some of the other areas. I would say where there is like compelling, like investment opportunities on the services side. So like, monitoring of transmission assets and, monitoring whether there's too much, overgrowth of vegetation and things like that, which actually, causes huge problems for, transmission lines. There are now like services companies that are, there's one technology that we've looked at. It's called dynamic line rating. And basically the idea is that on all these wires, like they're underutilized most of the time. Like so basically the amount of like the wire is basically rated for the worst case scenario event. So like, basically the utility says the maximum amount of power that can go on this wire, is only such that, can be basically carried if like the conditions are horrible. But like most of the time conditions aren't horrible, right? And so with like these, dynamic line rating services companies that basically they like provide like a sensor and like they provide it as a service, they'll sense like, is there risk room to add more power through a wire and, can that kind of relieve some of the congestion issues on the grid? So I think the services businesses like around, you know, transmission monitoring, vegetation management, even like just construction and engineering design, like designing, new like kind of power substations. I think those are the areas that we find pretty compelling. Most of those businesses are like, service business models with, long-term contracts. It's fairly sticky business because, it's pretty hard to be displaced once, you're selling to utility. I mean, literally, oftentimes, you've been regulated in, right? Like things at a utility, like decisions that are made or approved by like a public utility commission, right? So it's fairly sticky business. It can be challenging to obviously break in and scale and acquire new customers. I think that's like the challenge. So you have to, find kind of the diamonds in the rough because these businesses aren't really going to necessarily be super high growth, even if there is high, growth in the like moderate growth in the market. So like it's how do you find, these compelling, stable businesses at like an attractive price? I think like that's the challenge there.
Yeah. I guess this piece, the second of the four, the grid and transmission, totally understand kind of what you're saying. I think the couple thoughts that I was thinking about is the end user is a utility or a government or something, right? Presumably. So there's sort of that
Yeah.
angle, which you're right, kind of breaking in is hard, but then it's much more sticky. I guess does the growth necessarily come from I'm in Houston or I'm in sort of Texas and I'm going to grow to also servicing, Oklahoma or Georgia or some other part or wherever in the country. Is that how like horizontal kind of growth happens in some sense, or is there more kind of vertical growth happening? Because otherwise, feels like this
Yeah.
is like a GDP plus type of growth situation, right?
Yeah, I think it's a great question. I'd say it's a mix. Like, on the one hand, also when you think about the overall market and just like build out of new transmission, transmission's super old in the US. Like your average transformer, for example, is like 25 years old and the useful life's like 25 years. So there's like a big replacement cycle that needs to happen. And obviously, with rising power demand from data centers as well as, new renewable capacity added. And that's where, again, like these things overlap. Like you need more build out of transmission and substations and all of that stuff. But it's not like, 20%, 30%, market CAGR, right? Like we're talking, like 8% versus like, 2% historically or 3% historically, right? So I think to your point, like the way you grow is, yeah, you basically acquire new utility customers or it's through, M&A at the end of the day. So I think, the yeah, those are the real growth angles. But again, I think these are more kind of cash cow businesses. At least that's really the way that we look at them. And then it's about finding like a business with a really strong moat. They have like some real engineering expertise or whatever it may be. They've been working with the utility for a while. They've got a great customer relationship, and you can. It's hard to find these businesses at a compelling price, but like price matters a lot in this
Right,
world, right?
right.
That's the key.
Right. No, I totally get it. I think these are like in any portfolio, right? You want to be a dominant player, like for you guys, which you are and becoming more so like you want to, it's kind of you have to own different types of assets to kind of mitigate some of that risk, but also to sort of, to your point, help the other piece of the business grow as well. So I understand kind of each of these sectors have different cash profiles and also obviously growth profiles and all of
Yeah.
that. So that makes sense. So shifting to the third one, Will, great job so far. On the consumption side, this I think is probably the most fascinating, even for like the day-to-day person out there. There's just
Yeah.
like so much going on in this space, almost like, all the time. We often forget about the generation. We just focus on consumption. So I'm really glad we started with the generation and the grid to sort of figure out how everything's set up. But talk to us about consumption. Obviously, there's a ton of really cool things going on here related to both technology and consumer behavior. So maybe talk to us about what types of exciting things you've seen here. How do you evaluate these types of businesses and so on in the consumption space?
Yeah, I think it's a great question. I think the most obvious consumption business that comes to mind, but also one that's incredibly overlooked is EVs and EV charging. And EV charging has been absolutely battered in the media. And why? Because of the political climate, right? Like rolling back subsidies for EVs and EV charging, right? Like that was what was codified in the latest bill that was passed. And I think so, yeah, there's a lot of, negative sentiment in the market on EV charging. But again, look at the fundamentals, right? Like EVgo, they're a fairly large, probably one of the largest charge point operators, meaning they operate like public charging, stations in the US. They're public. Their utilization rates, meaning like how frequently their chargers are being used, right? Like how many hours a day are they using the chargers? Like the utilization rates have been steadily growing from, 10%, maybe 2 years ago to like 20% today, right? So like the kind of proof is in the unit economics and the data to an extent, right? Like EV adoption continues to grow, maybe not at the same rate as it was before. EV charging economics continue to improve, utilization rates are improving. So I think we see EV charging as like a pretty compelling opportunity, both public, and at home. And I also think it's like an interesting opportunity just given how fragmented like public charging is. There's sort of two or three gorillas. It's like Tesla, you know, EVgo, right? And then who's next? There's like a long tail of companies that have installed, a fair number of chargers, but they're subscale still, and so it's going to be hard for them to compete long term. And they're probably great opportunities to make, their projects, their chargers that they own even more profitable. So I think that's an area we're really interested in, EV charging both public and at home too. I would say another really interesting, opportunity on the consumption side, we alluded to it earlier, but again, like home batteries, I think, the adoption rate continuing to grow. If you look at Sunrun, right? So Sunrun is they're basically a large think of it as like a leasing company for residential solar, publicly traded business. Their quote unquote storage attach rate, which is basically how many storage systems are attached to home solar in California is like now like 90%, and nationwide it's like 70%, right? Versus a few years ago it was like 40%, right? So the storage adoption rate with rooftop solar at home, this is again residential, has been rapidly expanding. And then, customers can, homeowners can kind of make money from those systems by even using them, to basically arbitrage, right? Like you can fill the battery when power is cheap, and then when the grid needs it, when it's expensive, dispatch it, A, like from your own battery, and then B, like again, now there are these businesses that coordinate all of these batteries, as well as other like devices like smart thermostats, EV chargers, et cetera, to orchestrate them and provide the power, to the grid, or remove like the power demand from the grid when the grid is stressed. And homeowners can, clip some money from that, right? Clip like a share of the profit from that. So those are the areas we're really excited about right now, I'd say, in consumption.
Yeah, I actually, as you kind of talk about it, I truly think the generation will come first and then the consumption it will kind of come on. And then I do think that to me is one of the most exciting areas of energy going
Yeah.
forward in the next 3 to 5 years. Because like the way we consume, the way we like technology is changing every little thing of electronics and stuff we do in the home and energy, all of that is at such a fast pace that I do think that's probably going to have the most even like to your point, there's a lot of exciting models in there. So amazing. Well,
And
I mean, I
and,
think
and Kaushik, one point, it's all economics. That is it. Like if you're a homeowner and you're thinking about installing rooftop solar storage, what is the decision you're making? Is this cheaper than my like power bill, right? And look at what power bills have been doing. Like power bills have been skyrocketing, like in all states. And again, this is also driven by data center build out, by, aging transmission, because the utility has to basically pass on those costs to the homeowner, right? So like they're consumers. That's how utilities make money, right? So there's really a flywheel of the way all these things interact, and rising, retail, power prices. If you're a homeowner, that really drives like the economics on buying, all of this stuff, buying an EV, right? So I think, and buying like a solar system to power that, buying a battery to power that. So I think that is what's so fascinating, the way this is all, one connected thing, right? And it's
yeah,
a huge political thing too. It was like the number one topic on the ballot in the New Jersey gubernatorial race, right? So
yeah.
so that's really
Yeah,
what's fascinating
that's a
here.
good point also, actually. So kind of like there's the cost side, which is also being stressed by the general stress of the grid and all the other sort of requirements of these data centers. And so that's potentially like in a reverse, like a backdoor way, like necessitating people to rethink like, okay, like, if our costs are going to go up, we should make these like capital projects. So
Yeah.
completely agree. And then the next segment that we wanted to just spend a few minutes on is kind of the power for the digital infrastructure. This is like perhaps the fastest growing area, right? In sort of the space.
Yeah.
Everything's powering kind of the data centers, the AI economy, the digital economy, and will continue to do so, right? So maybe just you've touched on it a little bit, but give us just an overview of what you're seeing in this space. How does PE play here? Types of business models and sort of the prognosis, right, for the next or the outlook for the next 3 to 4 years here.
Yeah. Great question. So two terms I'll highlight. A, power quality, and B is grid reliability. These are two incredibly like important topics in this conversation. So obviously, everyone knows data centers need power. I think this is like undisputed. Like this is just common knowledge at this point. Like power is the number one thing they need. Like all data centers are trying to get their hands on power. Like they're trying to, get their hands on like grid interconnects. They'll even, bring their own backup generation if they need it, right? Like I don't think that's lost on people. But I'd say there are some issues that are lost on people. Number one, power quality. So these data centers for AI, when they train, right? The power quality profile is like a mess. So basically, when these GPUs train, don't ask me the science, but when they train, they basically cause huge spikes in power demand in like a matter of milliseconds. Think as much as like a 2x spike from your baseline demand in milliseconds. And it's constantly happening. There's this, what we call it power pulsing. When AI data centers train, they have like a power pulsing effect. Like the power demand spikes rapidly. Um, and that wreaks absolute havoc on basically everything connected to the data center, right? Like the backup power, all of the power distribution systems, everything on site at the data center that is connected to, power, like it just wreaks absolute havoc. Because like, backup generation as an example, these are turbines. Turbines, they're meant to spin and they're meant to spin for a while and keep spinning. They're not meant to ramp up and ramp down. Like they're meant to spin and spin at the same rate for a long time. So like we literally have seen data centers breaking the drive shafts of backup generators, right? It's fascinating. So that's where if you can, bring in a battery or bring in a battery with a really smart kind of power quality control system, that can basically completely solve that problem. So that's been a, really exciting area that we're spending a lot of time looking at, and it's an area that we focus on through our portfolio. I'd say the other issue is reliability. So there was an event back in March in the PJM territory. Think of this as like the grid territory in Maryland, Virginia, kind of the data center, hub corridor, right? There was an event basically where for whatever reason, the data centers saw some anomaly in the grid. Maybe it was in the voltage in the lines, and they all simultaneously immediately switch to backup power because these data centers they can't shut off. If they see there's an anomaly in the power that they're, when they're connected to the grid, they're going to swap to their backup generation. Can you imagine if you're a utility operator and you see this like 50 huge like loads, like data center loads, all shut off at the same time? Like, can you imagine the havoc that causes? It's incredible. And again, that's where adding battery storage to data centers can really play a role because if the data center does trip offline, the battery can then basically replace the data center and suck up, the power demand from the grid. Because the thing with the grid is the supply and the demand always need to be balanced. If there's an imbalance, it basically screws the whole grid. So if you have a large source of demand drop offline, you need something to supplement that. And that's where reliability matters a lot to utilities and, and allowing, utilities, they want to obviously connect these data centers, but they're not going to want to connect them if they're going to cause huge reliability problems like a potential blackout.
Right. And so that's super helpful, and really, really well described. I guess in this space also, with the AI requirement for data centers and all that, is that completely like throwing off projections that were expected? And sort of are we now we're
Yeah.
bringing on so much more kind of demand right into the system. So how are we solving? I mean, very quickly, like how are we solving for that? And maybe my second question is that in this space, is it similar then where you have the hardware sort of providers for like the actual equipment themselves, and then you also have the software monitoring and sort of services? Is that the similar type
Yeah.
of models you're investing in as well?
It is. I would say like the kind of market landscape's a little more complicated. But to answer your first question first, yes, you're right. Historically, we were in an era of, flat to slightly growing power demand. Think, like 1 to 2% per year, right? Like 1 to 2% CAGR. And now, that's completely flipped on its head and, power demand is exploding, growing like 4 or 5% per year, which again doesn't sound like a huge change, 1 to 4, but like it is, right? When you think about gigawatts, terawatts of power, like your overall power ecosystem. So you're right, it's completely changed. Then in terms of where we look, yeah, I'd say we mainly focus, like there are a lot of different hardware components to a data center. There are components that manage the distribution of power into the different racks, right? There are components that basically manage the power before it flows into those kind of distribution units. there's obviously data center cooling companies, right, that are focused on cooling the chips, but also cooling the power equipment. There are companies that are focused on power quality, like one of our portfolio companies, does that kind of alongside with battery storage. So yeah, we look at all those types of businesses. Obviously, where they are today is, they're kind of all trading on peak margin, right? And like peak multiples. So we're more value investors. It's a little more challenging for us to invest in some of these types of businesses, but there are really compelling situations that we've seen. And obviously, again, through our portfolio, we're able to sell into that. So yeah, similar types of businesses. I would say like the market structure is interesting where you kind of have the hyperscaler end user oftentimes. Then you may have like a co-locator, which is basically like a data center landlord who, rents out the rack space to a hyperscaler. Then, who do they buy from? They actually don't even buy from like the hardware vendors directly. They tend to buy more from like an integrator that basically takes all the different types of hardware needed and packages together. And then there's obviously like the hardware vendors, right? And then on top of that, like to your point, there's like a lot of, there are a lot of like, monitoring like asset health businesses to monitor like all the different like power equipment on site. Typically, that sale will happen into the co-locator, right? Like the landlord. So that's kind of how we think about like the market segmentation. We're more looking at the hardware side, to some extent looking at the monitoring side as well. But it's all rapidly changing too, Kaushik. That's the thing, right? Like these chips change so fast that racks can become obsolete, right? In like 3 years, right? Or like, suddenly you go from an architecture where the racks are drawing, a certain voltage, maybe it's 30 volts to now like 800 volts and it's direct. So everything's changing incredibly rapidly in the sector. And I think that definitely makes it challenging to invest.
Yeah. Yeah. Challenging, exciting, and like, kind of definitely at the center of all this. So amazing. So, hey, last section, we'll kind of jet through these questions. Again, really amazing job. I think this is one of our first energy
I'm
speakers that
delighted.
we've had on. So super like learning, great learning for me and for kind of everyone who's listening here. I just want to kind of hit on three areas. One is, kind
And
of some of
Kaushik,
the,
before we depart on this area
yeah.
very quickly, because I know we have a lot to get to, but I think like people are very scared about going into this sector because of the political environment. Let's just be frank, right? Like people hear what the administration's saying about renewables, and people are like, "Oh, I shouldn't go into the sector. This is a dead sector." We see this as just the opposite. Unit economics incredibly strong, getting even stronger. Huge constraints on adding more conventional generation to the grid. Like the the lead time on natural gas turbines is 3+ years, right? So like, where is the power going to come from? It's going to come from, renewable clean sources. And as a value investor, like what an exciting time, right? Like out of favor sector, market tailwinds, with this whole AI boom,
Right.
like strong unit economics. We think it's as a value investor, it's just
And this is
really, really
as
exciting.
acyclical as an industry gets with sort of this like
Yeah.
huge, you're right, the tailwinds on like what the future needs to be. Yet at this time where it's sort of undervalued, I completely agree with you.
Yeah.
I think you're exactly right on this one. Um, and it's one of those things that it's never going to go back or never going to like get less. It's not like we'll have more population, we'll have more need for technology, all this stuff. It's not like you're going to need less power in the future. In fact, if anything, it's going to be more better, more efficient power and all this stuff. So I actually completely agree with you. And so for everyone who's listening, I think, if you're thinking about sectors that are sort of have that longevity, and yet are critical to like the economy and the ecosystem, I think this makes a lot of sense. And especially doing it at a time where, unlike 2020, where you can actually potentially do some deals in some sectors that are reasonable. I think
Yeah.
that all makes sense. Yeah, and I think Will has done a really good job of talking about the entire sector in a way that I actually haven't heard before. So this is really, really exciting. I think the last area that I'll cover with you, Will, in kind of a quick faction is just breaking in, right? Let's talk about kind of the process, right? I think there's many quality private equity, growth equity funds in the energy space. Maybe just talk to us a little bit about what are they looking for? What does a recruiting process look like, right? And also kind of maybe standing out as a candidate, right? So I think generally it's okay It's completely fine to be a generalist who has an interest in the sector to kind of go in from an M&A background or a technology
Sure.
background or industrials background. But talk to us a little bit about how to break into these sectors of investing and kind of what are you guys looking for?
Yeah, I think it's a really great point, Kaushik. I'd say there's sort of the standard answer, and then there's the how do you really differentiate answer, right? The standard answer is like, look, like private equity, the process is, you know, relatively regimented. There's on cycle, there's off cycle, there's the headhunter meetings. You do the headhunter meetings, you tell them you're interested in the sector, they'll reach out, you study your models, right? Like you know how to do an LBO, you do some practice case studies, you go into the interviews and you crush it. Like that's like the standard answer, right? And that is all important. Like keep in mind, like that obviously like to go into any interview, you need to have that stuff prepared. How do you really differentiate? Like how do you really stand out? That's where I think really just reading about the sector, one, um, trying to build your network in the sector. So like I'll give you an example, right? Like most people probably don't do this. When I was in banking, I like networked like a dog in the sector. Like I would literally go around, looking at various portfolio companies of like private equity firms in the sector, because those seem like just potentially good, interesting companies to reach out to. They've got, institutional backing, maybe they'll go somewhere, right? Like literally just reaching out to people at these companies, like execs at these companies, like CEO, CFO, like start with school alumni, then reach out. Like I was just like really, really, dogged about growing my network with these companies. And surprisingly, like obviously not everyone answers, but a decent number of folks answer if you just say, hey, like, look, I'm really interested in the sector. I'm doing banking. Like this, and throw in something specific, like, hey, like I read this about your company or this recent thing that you guys announced. Like, I think like this is a really interesting way to look at it, or, I'd love to learn more about it. Like people will respond if you can grow your network in the sector. A, you'll learn more about who the companies are, who the relevant players are, so that when you get in interviews, you can speak intelligently about the stuff. But B, like you may even again like meet like the portfolio company management of like the place you're interviewing at, right? And then it's like, oh yeah, I know all about your portfolio. I spoke to like the CEO of your portfolio company, right? So like again, a little out of the box, but like why not? Sky's the limit. So I think that that's a great way to learn, great way to grow your network, obviously into the future. So that helps down the road, and also just again could be directly like very useful. So I'd say like just network your tail off to the extent you can. Most people don't do this, but I think
Yeah.
especially when you're in banking, it's a real differentiator.
I honestly like that. That was so refreshing and amazing to hear. As I see, thousands of you guys go into the industry and be successful, it truly is those people, who kind of, to Will's point, right? You don't need to have a title. I mean, obviously it helps, but you can start learning about the space whenever you want. In fact, some of the people that are listening now are students or MBAs, so you should start now. Obviously, your response rate will be a lot lower, and you kind of figure out where you want to do this. But if you
Yeah.
kind of express, you know a really good, strong reason for why you're reaching out to someone, add some value, and then sort of be able to kind of really justify, hey, I'm asking for 15 minutes of your time, but I promise I'll make it worthwhile because I've spent some time in this space, or I feel like, I love what you guys are doing. I want to learn more. Whatever it is, I think you'll be surprised, like Michael Jordan said, right? You miss every shot you don't take, right? Or 100% shots you don't take. So to Will's point, it doesn't matter what the conversion is. I also think it's a life skill, right? So now that Will's a VP, a lot of his time is spent on networking, building relationships, et cetera. So why not build your own brand early on? And so, I mean, my point there is just you don't need to ask permission to sort of do this. You just kind of do it, and see sort of what happens. I think that's something that is very underrated, and not a lot of my analysts or associates do that. But the ones that do it, are extremely have kind of this fast track and sort of this launch pad into the industries and careers I want to get into.
Yeah. And
Amazing,
and
amazing, Will.
have and
Yeah, tell me.
have the other thing is have a pitch. Like come up with an investment idea that could meet the mandate of the fund you're looking at. They may not go for it, but like if you take the time to really come up with a pitch, like really learn about a company, the product, map it, like come up with like make like a makeshift, very brief like IC memo. I did this myself, by the way. Like I made basically like a makeshift like brief IC memo on a company in the sector that I thought, could meet the mandate of, you know, the type of investing I was interested in doing. And I even reached out to some of the management team to like get to know that they didn't end up responding. But like still, got to know the company, had a pitch that I could literally go in with, or like for a case study, like I could work with, right? Like it's super valuable to have like ideas that you can bring to the table. People like that, even if it's not the ultimate idea that, that folks will go with at the firm you're looking at.
Completely agree. And I think the other reason why this is important is private equity, especially at that senior associate, definitely VP level, is becoming much more sectorized, right? Yes, there's generalist programs out there, et cetera. But at some point, you are going to have to sort of pick sectors or go join teams that are kind of more sector specific. And where to really stand out there is, to Will's point, number one, establish that you like this space and you kind of are thinking about that space. And number two, like, almost doing the job in that space. So picking two or three companies and maybe it's talking to managed streams, or maybe it's doing a lot of desktop research. And then number three is identifying, especially for the upper middle market, lower middle market firms, like their investment thesis and why that fits into their investment thesis, right? Because at the end of the day,
100%.
understanding the firms you're going and joining is sort of the other aspect here. I want
Absolutely.
to kind of a couple more questions. One on the
Sure.
technical kind of case study side, just maybe shed a little bit of light for an energy type private equity interview. I mean, we talked a little bit about the modeling and things like that, but what to expect in a case study? Like, is it like they'll give you a project and a bunch of cash flows, and then you have to kind of like model it out? Or, is it more like it's like a hypothetical investment, or is it like come up with an investment? Maybe give us some examples or flavors of how those
Sure.
case study interviews go.
Great question. I would say first, it depends on the type of private equity fund, like infra versus growth infra versus private equity growth. But let's just say it's private equity for now, right? I would say, A, important to kind of understand just like how this, like what is ultimately being sold. I guess maybe the way I'll put it is most people don't understand like megawatts and megawatt hours as like a unit. I think people are very used to looking at P times Q businesses, and this is like, it can be a P times Q business, but the Q of like a megawatt of energy or megawatt hour of power or megawatt of power, megawatt hour of energy, for some reason just confusing to people. So like just get that through your head. Like if it's an EV charging business, they're selling like energy, like kilowatt hours of charging. Like if you're looking at like, some hardware business that sells to a power plant, they're going to be selling units of hardware, but the units are normally sized to like a specific amount of power, right? So like just kind of getting that through your head, like how that works, I think it can be challenging for people, especially if they're not living, breathing the sector. If you are, you probably understand it, but if not, it's a little confusing. So I'd say that's the first thing. The second thing I would say is the way these are typically structured, and at least this is how it is for us, is like you'll basically get a company. It'll probably be like a company, maybe a public company, could be like a company that's representative of a type of investment that the firm would do. So, maybe it's a hardware business, a services business, um, some other interesting type of business model, but it's typically not going to be infrastructure. So they'll give you like a company, some information on it, ask you to like build a model, right, of like the investment returns in the company, and then basically, have a view on whether you would invest in it or not and why. What is the number one thing like to hacking these interviews? I would say it's you need to have a view on everything. It can be like, it doesn't have to be the most well-researched, like PhD level view on your DSO assumption, like your working capital assumption, but just like have a view on it. Like have a reason for putting the numbers in the model that you put. Again, it doesn't need to be like necessarily the right or the most well-researched answer, but I think having a view, so like you can say, yeah, I forecasted this in the model because I think as they scale, they'll be able to command, better terms with their, customers, and, they'll be able to lower their DSO, right? Maybe that doesn't make any sense, but at least you have a view for saying, I flatlined it because that's what we do in banking. Like that's the worst thing you can do. So I'd say have a view. Like even if you don't know if it's the right view, that is the most important thing on the numbers, on the business, like on everything you can. I think that's important.
Amazing. I couldn't agree more. I think this is something like whether you're an undergrad or an MBA, as an analyst or an associate, learning about these industries, learning about these business models is kind of an ongoing occurrence. So like you just kind of get in the mode of reading industry journals, et cetera, digging into 10 case so that when you come to when you come to a case study, sure, the terminologies might be slightly different, but you finally, the fundamental skill I want everyone here to grasp over the course of their career is just if you want to be in the business and investing space, just know how to think about business models, all sorts of different business models, and really try to get to what are the 4 or 5 things that move the needle in any sort of different case, and how do I identify those? How do I quantify those? And then how do I take a point of view on that and then kind of present that, right? So I think all the modeling and stuff is important, known, but I think if you don't know what to model and kind of how to model, like what are you actually modeling and what are you trying to get to, it's always harder. So
Yeah,
amazing.
and
Well,
Kaushik,
yeah.
I'd say have a framework for going into any of these
Mm,
situations. Like you need to have some type of a framework for analyzing a business when you're at the stage of being, an undergrad or like a banking junior and you're trying to do these interviews. Like if you can have an organized framework where it's like, this is how I'm going to dissect this company. I'm going to start with like their product and then how they turn it into revenue and then how they turn that into margin, right? And like even if that's your framework, like have an organized framework so you can go into the interview and just be very well prepared. I think that's
yeah.
important.
Amazing, amazing on the framework. The final thing we'll just kind of wrap with this is that you kind of mentioned everything you look at as economics, cash flow, business, et cetera. How much of the pull to clean energy for you is like the ability to have a lot of impact in the world, right? Kind of this is not just a US problem, this is or a challenge, this is sort of a global challenge as well. I'm sure you're looking at companies that do things in locally as well as globally. Like maybe just touch a little bit because ultimately, right, we're all driving our careers towards I
Yeah.
always, when I go on campus, tell you the three things you look for, right? The things that you are genuinely passionate and interested in. So in your case, it might be clean energy or energy, and then something that you're really good at, right? For anyone, and then combine that with the third thing, which is how do you drive impact, and what do you define as impact? So maybe talk just for 30 seconds, Will, on and does that have any sort of factor and kind of how does that how does that kind of go in your mentality when you kind of work in the energy space, which is just a tremendous amount of impact in addition to having a tremendous amount of returns, right?
So yeah, I'll break this into two parts. I'd say I alluded to this earlier, but I think there are a lot of people that were in my shoes in college and banking where they're like, I'm kind of interested in a lot of things. How do I pick? How do I pick an industry? Do I have to pick an industry? Like, I don't know. And I had like a insightful moment at one point where I realized, like, look, every business, why do they exist? They solve a problem, they have a value proposition. Maybe like they're helping, they provide a drug that treats some type of cancer. Maybe it's like providing energy that's clean for the environment. Maybe it's like, you know, maybe it's something else, right? But find like a problem. Maybe it's again, cancer, the environment, education, whatever it may be. Find the problem that's most interesting to you and like most that really speaks to you. And like go from there. Like why don't you spend your time on businesses that are working to basically solve that problem and investing in them or working at them? And like that's what drew me to the sector. That's how I made my decision ultimately. A was the disruption, the rate of change, but it was like it's solving a problem that I care about. And I think that's like a very helpful way to take a step back and think like, what do I want to do with my career? It's like you're going to work on some problems, whether you're working at a company, whether you're investing in companies, like everyone's trying to solve problems, work on problems. What problems are interesting to you?
Amazing. Well, we couldn't end on a better note. Well, I do want to thank you so much for spending this time with us. I think everyone who's going to be listening is just going to be learning so much, not just about energy, but about models and kind of how to think about sectors, how to think about businesses, and more so like how to think about your career and achieving kind of great success there. So thank you, Will. Really appreciate it. I look forward to you know we engaging. Obviously we work with you guys, your firm, across all these different all the things that we'll work on together, but also individually, having you on more of these sort of things, and a lot more of our folks obviously getting interested in energy, but then also kind of having the same amount of impact that they can in their career. So thank you, Will, and look forward to it for the next time. Okay, have a great thanks, Will.
Awesome. Thanks, Kaushik. Really
Awesome, man.
appreciate the time.
Thanks as always, buddy. Okay, see you soon. Same man. Bye. Thank you.